So the currency market, Forex, foreign exchange, is exactly like how you would exchange your money from Canadian to the US dollar. So you go to a foreign exchange teller, you give them $100 Canadian, and you'll get like $2 US because our currency sucks. But yeah, so that gets exchanged at that current market rate, and currently that market rate's like $1.30 for every US dollar you exchange. So that market rate is just fluctuating all the time, every day, every minute, every 5 minutes, every week. And we're able to capitalize on these moves by trading these currencies and specifically their currency pairs. How we do this is through a broker. So, I mean, your bank, if you're in Canada, specifically Alberta, it's very shitty. You're kind of stuck in the dust till you make like 200,000 a year. But yeah, your bank can be your broker. A broker like FX Choice can be one. TD Amnorite or whatever that's called. There's lots of brokers, many brokers, and very good brokers too, like Pepperstone, FX Choice. I think it's AAFX. All very good brokers. And what these people do is they allow us to place these trades. So let's say you wanted to buy the US dollar, Canadian dollar. You'd be able to do that through the broker and use leverage to be able to make the substantial gains we do. Because if you're going into the market with how much we usually go into when we start, like $50 to $100, you'd be buying like $1 or $2 US to be exchanging it for a few cents to that dollar for the exchange rate. And how we capitalize on this is leverage. So with our $100, we're actually able to be trading the value of hundreds of thousands of dollars. It sounds scary, but you won't ever owe your broker money if you have a good broker. And if you don't know what broker to use, just message me and I'll send you the good ones. But what they do is they'll stop you before you lose money and owe them money. And that's called a margin call. But you'll learn more about that as we move on. But what we do is we trade these currencies. So back in 2012, the US Canadian dollar were at par. It was a 1-to-1 exchange ratio. Today, you can exchange one US dollar for $1.30 Canadian. So we are able to make lots of money on these fluctuations. And like I said, it fluctuates on a daily, on a weekly, on a minutely, on an hourly. So you can really tailor how you trade with your lifestyle. Like for me personally, I was trading very intraday, so in and out of trades within a day, in and out of trades within a few days, and now I'm holding trades for what, 4 weeks. I mean, I'm still in my US Canadian dollar sell that I got in like 4 weeks ago. I'm probably holding that for like another month. But again, that's just how I'm trading currently, just because my lifestyle, how much is going on. I have so many projects going on. I'm back at work, so lots of stuff going on. So I'm putting very minimal upkeep time to my trading. I'm not doing my 20 trades a week anymore. I'm doing like 2, if that, because I'm looking at the daily candles. I'm looking at the weekly candles. So I really have to be patient for my data to come through. But like if you look at this, each one of these candles on this chart represents 15 minutes. So this is 15 minutes of price action. And it's actually moving right now. So, and even this move right here, which would be an hour and a half, that's a 10-point move. You could have made $1 to $100 there, depending on your lot sizes and your balance. And that's just within an hour. So I'm looking more on the big scale of things where each one of these candles is a week. And I'm looking at this market to come way down here. And that's where I'll be getting out. Maybe back up here where I'll be getting out, but still. And this trade will get me a lot more than a few bucks or a few hundred. but that's the patience to it. You can get the same amount by trading. Yeah, that was 600 points. So, oh, damn it, this is being so messy. So yeah, this is like 700 points. I mean, that could make you $60,000 to $6,000 depending on your account balance. But again, that little area right there, that's 35 days. You're waiting 4 or 5 weeks for that to pan out. And I'm looking long term, like 6 months for it to pan out. So you can suit your trading to how your life is. If you have the time, you can be in and out of the market from like 8 to 12 a.m. or 8 a.m. to 12 p.m. in and out and make a good amount of money. And I personally know many traders who do that. I followed one who makes over 100,000 a year. He's consistently done that for 2-3 years, and he's done trading at 11 o'clock. He doesn't trade every day. He'll trade Monday, Tuesday, Thursday, Friday, and he'll make his money, and he's living good. But like I said, you can suit your trading style to how you need it to feel or be for your life. So that's that. Forex in a whole is currencies. We're trading currency. It's exactly like stocks, but instead of buying stocks, we're buying currencies. And when we sell currencies, we are shorting it. So I call this, I don't know if this is an official term, but I call Forex a bilateral market. What that means is you can make money while it's going up, or you can make money while it's going down. So you can, what people say, you can go long right here and make money all the way up, or you can short the market from up here and watch it go down and make your money. So that's what I mean by a bilateral market versus stocks where you have to wait and buy, hold, wait for the price to increase. We can buy or sell depending on the market, on the current conditions, and be able to make our money that way. Like I said, just this hour and a half, you could have made a few $100, $10, $1. Depends on your account size. I want to kind of touch a bit on mindset because, like I said, trading is 90% mindset. It's 10% doing the work, studying, learning how to read markets, learning how to look at charts and know what you're looking at, and especially learning what these candlesticks each individually mean. But that's only 10% of it. The other 90 is dealing with the greed, dealing with the fear, dealing with trusting yourself, dealing with being in a trade when it's red and wanting to get out and cut your losses, being in a trade when it's green or blue and wanting to cut your losses because you don't want to lose that profit. You really, really, really need to harden your emotions to be able to trade, because that's where 95% of traders fail. They can be excellent traders, but they won't have the emotional balance to stay into a trade, to see it out, to cut their losses when they should. It's a really emotional game, especially when you're trading with your own hard-earned money that you're putting on the line. So you're going to need to be comfortable with taking risks and letting your risk or your reward extend further to maximize your gains. And you also got to know when to bite the bullet, because not every trade's going to win. And some days you'll be on winning streaks where you've won every trade, and some weeks you'll be on losing streaks where you're losing every trade. And you just got to adjust your trading and adjust your emotions to be in check with everything. To give a little personalness to this call, one of my buddies has just lost 3,000 in one day within like an hour, and he was devastated, but that's just part of the game. And I mean, he's already made most of it back, but again, that's part of the game. You can win it just as fast as you lose it. A lot of people will compare this to gambling, but it's not gambling, because we have strategies. Gambling is when the odds are rigged against you, and this is kind of like playing poker. You can be a professional poker player. You can't be a professional gambler. Poker, you have odds and probabilities for each hand that you get dealt, and same with trading. Trades will pan out into a certain way to look in a certain market, and you'll have more chances or odds that it will go in your favor. And you adjust your bet size accordingly to the amount of odds in your favor. So just like poker, you can be a professional poker player just as you can be a professional trader. There's many, many, many people who have done it for decades, even to the extent of 50 plus years. So gambling won't take you 50 plus years. Gambling won't take you more than a year. You got to refine systems and you got to stick to them. And that's, again, where the mindset comes in. You got to stick to your systems, you got to stick to your guns, and you got to harden your emotions. So back into Forex. I'm going to play this short video. It's going to tell you everything about Forex, kind of summarize what I just told you about everything, and kind of give you a better example and rundown than what I've given you. Then I'll go into more in depth with stuff to kind of get you guys to where the next session will be. And Tuesday, I'll be doing another one where I'm kind of trading the markets with you. Should be interesting because I haven't traded short-term time frames for a while. So, but yeah, we'll watch this video quickly and then we'll be on our way with the rest of the training.
If you have ever traveled to a foreign country, you may have needed to exchange your money. If so, you have already participated in Forex trading. Forex is the short form of foreign exchange. Well, Forex is a bit more than that. For example, companies buy goods from other countries. In order to buy them, they need to obtain the local currency first, just like us when going on holiday. The difference is they will exchange huge amounts. When these companies exchange these huge amounts, they will actually move the price because the demand for the currency that they need increases. When the demand increases, the price increases. With all this exchanging going on around the world, the exchange rates constantly move. This is how it works. When currencies are exchanged, they have a certain price, the exchange rate. As in any market, the price of a currency is determined by the law of supply and demand. If there are many people or companies that want to change euros into dollars, the price of the dollar will rise against the euro, and so the exchange rate will change. Let's use an everyday example to explain how you can actually profit from this. Say you live in Europe and went on holiday to the United States. Let's say that you changed your 500 euros into US dollars at the rate of $1.4 for every euro. You got 700 US dollars, but you do not spend any money at all. So you still have $700 after you come back. After the exchange rate moved from 1.4 to 1.3, instead of getting just 500 euros back, you actually get 538.5 euros. You have gained 38.5 euros simply from holding your money in dollars while the exchange rate changed. This is essentially how we trade in the Forex market. We buy a certain amount of a currency, hold on to it whilst the exchange rate moves, then change it back, making money along the way. How to decide when the right time to buy and sell is exactly what we teach you throughout the rest of our learning lessons. As you can imagine, traveling a lot and saving a bit of money on your holiday budget and then exchanging it, it's not really a practical approach to trading currencies. Fortunately, there is an easier way to do this. You can trade currency through online exchange offices called brokers. What this means is that you can exchange currencies online throughout the day and take advantage of the constantly fluctuating exchange rates. Just as in the example of when you went on holiday, you can buy different currencies and make a profit as the exchange rates change. This is trading the Forex market. Trading Forex online with a broker has many benefits. You can trade Forex from your home or anywhere that you have an internet connection. The Forex market never sleeps. It is open 24 hours a day, 5 days a week, and so can suit your daily routine. You do not need a huge budget to get started. As little as $150 is enough to begin trading and building your account over time. Of course, it will require some learning until you get there, but this is exactly what TradeImo is here for. To help you learn how to trade in a way that can suit your individual lifestyle, and to help you navigate your way through the Forex market.
All right. So, any questions about Forex or anything? Pop them into the chat or speak. So that's Forex in a whole. We can make good money from it. Yeah, getting into kind of how everything's structured. So you'll see here on the side of my screen the different currency pairs. So I trade only the major currencies. I'm not trading stuff like the South African rand or like the Turkish lira or anything. I'm sticking to the major US dollar, Canadian dollar, euro, pound, stuff like that. Stuff that has the most amount of money pouring in and out of it. One thing I want to mention though is we trade different sessions. So the Forex market will open Sunday at 3:30 for Calgarians or Sunday at 5:30 Eastern Standard Time. But we'll go through different sessions through the day. And sessions pretty much mean when that currency market is booming or when it has the most money going in and out of it. So as you see here, we have London, New York, Sydney, and Tokyo. Those are the 4 currency sessions that we trade. They start in varying times and they overlap each other. And what happens is when New York is happening, that's when the most amount of money is in the US dollar or being exchanged out of the US dollar. When it's in London, that's when euro and pound pairs are going to be booming. Sydney, that's when Australian dollar, New Zealand dollar. Tokyo, that's going to be your yen. And we're able to trade different currencies through this session switching. Then we also get to see different liquidity or different volume of money coming in and out of the market through those times. Mostly you'll only be trading New York into Sydney. London and New York have the highest amount of volume, so you really want to be trading that. London has the highest volume, so it's going to have the biggest price moves. It's going to have the most liquidity. And when I'm talking about liquidity, I just mean that it's easiest to get in and out of trades. The market moves the most, and there's the most amount of money in and out of that market at any given time. So that's what I mean by liquidity. So kind of going back to the currency pairs, right now we're looking at the USD Canadian dollar. So what that means is the US dollar is our base pair. So that's what the Canadian dollar is going to be compared against. Then the CAD is going to be our secondary. So what that means is if the US dollar gets strong, the whole market will increase. If the US dollar gets weak, the market will decrease. But on the opposite spectrum, if the Canadian dollar increases in strength, that will push the market down because the Canadian dollar is being paired against the US dollar. So if the Canadian dollar then outweighs the US dollar, the whole market will kind of go into a downslope. If the Canadian dollar is weak against the US dollar, then that will give the US dollar more strength to be able to push up. And you'll see this happen all day, every day, as the market happens, as news gets released. And that goes without saying for each one of these currencies, like the Euro USD. If the Euro gets strong, then the market will go up. If the US dollar gets stronger than the Euro, the market will go down. It's an easy concept, but hard to grip your head around. At least when I was trading and learning how to do all this, I had very, very hard time wrapping my head around currencies getting stronger. And now I kind of realize that goes with news releases, government speaking, unemployment rates, stuff like that. I've actually been learning how to leverage it to go on a longer, bigger time scale, using the overall economy to kind of judge where the market's going. Then I can drop down time frames and look at where I should be getting in. Again, focusing just on currency pairs. I like using US dollar, Canadian dollar for currency pair examples. You'll see the price. So we have a 5 decimal price. So 1.31000. So we have 5 decimals that we're looking at. We count our moves to just the 4th decimal. That 5th one is just like our little move. We don't really count that. So if we say that the market's moved 10 points, that means it's went from 1.300 to 1.31 to that. So that's an increase of 10. Now, if it's decreased 10 from 131, then we'd be looking at 130. Or no, 130.90, because it's went down 10 points. Now, with US or with Japanese base pairs, we're looking at 3 decimal points. Just as a whole, take off that last decimal point. So anything paired with the yen, it's going to be a, what's market at? 108. 108, 450. So really the market looks like this. So if we go up 10 points, we're looking at 108.55. If it goes down 10 points, we'd be looking at 108.35. And that's how we're looking at these prices. We're really looking at micro moves that we're actually making good amounts of money from. Any questions? Because I know I may not be explaining this the best, or if you guys have questions. I don't know if all of you are unmuted. I don't even know how to unmute you. Oh, no, shit. Shit. Do I have you guys muted? Unmute. Oh. I had you guys muted. Sorry.
Oh, it's okay. I can unmute myself whenever. I just muted myself just so there's no background noise blocking your voice.
Thank you. But yeah, do you guys have any questions?
Not really.
I'm actually quite good.
You guys understand exactly kind of how this works and how it can move the market? Would you be okay with me touching on some chart stuff?
Yeah, for sure.
Okay.
I'm just listening and taking notes.
All right. So how I want each and every one of you to start is I don't want you guys using any indicators. Because indicators can be your biggest weapon or it can be your biggest crutch. Oh, we got a chat. Soaking it in, I'm a fat sponge. Okay, so indicators will, from the start, will be your biggest crutch. Because you may think you have a system, you may think you have the secret sauce, and let me tell you, you do not have the secret sauce with an indicator. You want to learn how to look at a chart completely naked, even if you are completely naked, and read exactly what it's telling you. So I want you guys to learn what's called support and resistance. Oh, fuck. My chubby ass fingers. We got another chat. Too much sauce. So I want you to learn support and resistance. You can also hear it being called ceilings and floors, supply and demand, but I'm calling it support and resistance because that's what makes the most sense to me. Support and resistance and trend lines. These are the most critical, crucial things you will need to learn. And the easiest, really. What support and resistance is, how you can define it, is, I like defining support and resistance is support, an area in the market that price tends to turn around at. Or I guess that would be support and resistance. So support and resistance is areas in the market that price tends to turn around at. So what that means is, let's hop to a daily, pick your time frame, get more examples. So we can say this area here, this 114 area, you would say that price doesn't really like going past this 114 area. So assuming that, seeing this whole area here, seeing how price comes up, taps it, comes back down, this would be called support. Or no, resistance, sorry. This would be called resistance because it's having a hard time pushing through that. So now it keeps coming up to here and just bouncing off. Now, would you say if we seen price come back up to here, you'd have a really high chance of, if you sold the market at this area, that the market would come back down? Generally speaking, yeah, because past data has shown. And I'm sure even if we place a trend line here, now remember, I haven't even looked at the previous market before this. I've done no preparation for this, so keep that in mind. I can bet you everything in my bank account right now that I can tell you right now, not much, but I can bet you everything in my bank account right now that 114 has been an area where price has reversed around. Let's see. It's actually used this as some support. So price kept coming back to this area and didn't want to break through it on the downside. So this area right here can be classified as support. An area in the market that price doesn't like to break through, or an area in the market that price tends to move at or reverse from. And it keeps on being used as resistance, support, it keeps flip-flopping. I mean, even these, I'd say, are in the ballpark. I mean, for a general perspective look of showing you how this works, I'd say that's ballpark enough. But again, just seeing how price is acting at this, it's been a staple time and time again, all the way back to 1994. 114 was a resistance. Back in 1997, it was being used as a resistance, then it broke up from there, then it used it as a support. So these points in the market is what we like to call support and resistance. This is areas in the market that price tends to reverse at. So now looking at a support example, I could say 108 right here, where we're kind of sitting at now, would be a nice area where you could say that if you bought this market, potentially on signs of it reversing or just flat out bought it when it got to this area, you'd have a higher chance in your favor for the market to turn around and go on, being bullish or going up. And that's really the whole essence of support and resistance. It's these areas that price doesn't like to break through, or price doesn't like to go past. It likes to reverse at those areas. And I can tell you that this is going to be a benchmark for trading. And I mean, even with that NZD USD, New Zealand dollar trade that I showed you, the whole essence of support and resistance is being used in that. It's just on an angle, and when support and resistance is on an angle, it's called a trend line. So this trend line is where price doesn't like to break through. It encapsulates a whole trend. So you can see that it just respects this level. And I mean, I can even go back and show you even more, like this right here. It respected this level until it started to break it. Then even after it broke it, it then used it as support again to then start a new trend. I mean, the market will just consistently do this time and time again. Banks, institutions will push the market in a way that they'll be able to manipulate us and also be able to make them profit the most. But as a whole, using these tools that I'm going to be telling you guys over the next 4 weeks, you'll be able to see how you're able to essentially beat the market or beat the big players in the market. And again, I'm just drawing trend line after trend line. This isn't pre-planned. This is just literally just how the market works. You just get time and time again trend lines that get respected, then they break and you're able to buy or sell the breakouts, or predict the market off of these trends and then be able to accurately make your judgment calls off of this. Looking at this example right here, we've started this trend here. We've then hit this area. So when we have 2 or more data points, that's what we can consider a trend. So we have 1 data point, 2 data points. If we're able to connect more, then that will consider it to be a stronger trend line. But here, all we had was 2 data points. So now, let me just put market back a little. Let's say all you had was this, and this is the current market you're looking at. Days are going by, which is each one of these candles. Days are going by, and you're looking at this trend line. And then you see this happen, this right here. Let me zoom in a little. So you see the market get down to this point, and we've only marked it from this. We've just extended it. And the market has made a bounce. So let's say you've waited for this candle to show that you have a doji candle at the bottom of the trend, aligning with the trend line. You wait for the next candle to close. That's standard procedure. You can set your stop loss, how you feel. Pretty sure this just generally set to a 1-to-1. But you can then accurately assume that the market will move from that. And from here it did, getting you you would have made 150 points or pips. The people who are in the Discord, they know that that's a very good trade. You would have waited 4 or 5 days. But again, this is the type of trades you want to be looking at. You've increased your chances instead of just randomly buying or selling when you place these trend lines, when you use your support and resistance. Further elaborating on this, let's say we've only seen this. We only have this much. We can then use our support and resistance and say, well, price didn't really like going through here. We can say that this area is something to be looking at for reversals. It didn't like pushing past it, and when it did, it didn't like coming back down from it. So if we keep on extend this out, we can then see that price moved right into that support zone, exactly how we wanted. That aligns with this trend line, and then immediately, soon as that happened, it bounced and we got our trade, we made our money, and that's That's how it works. You just have a system in place, support and resistance with trend lines, and you just trade it how it is. As for viewing the market, you really want to be looking at the market in a more broad perspective. So what I've been trying to beat into people when I do these training calls is start on the highest time frame, because you want to know what the banks are looking at. You want to know what the huge traders who are trading billions of dollars at a time are looking at. And what they're looking at are these high time frame charts, because banks are trading months and months of data. So you want to start on the monthly, and you want to identify your support and resistance. So, I mean, here we don't have any per se solid support and resistance that we've seen. I can say that we have a general downward slope to the market. I'm expecting to see it make a new low past this one. This could probably take a year or two to actually pan out. So that's a year there. So yeah, a year or two to make the next new low before the bounce. But still, you want to be analyzing where the market is. Then you just drop down, and then you see each time frame and what it's telling you. And again, this is telling me that the market's pushing down and having this little consolidation, and I'll be looking at getting in when it has the next push down, because I already know that the market is looking to be going down. So if you're buying in a downtrend, you better hope that trade is short term. If you're selling in an uptrend, you better hope that trade is short term, because the trend will be your friend. And how you identify it is by going to the higher time frames, the monthly, the weekly, the daily, then going from there and breaking it down to how you see it. So with this, I mean, we're looking at NZD/USD right now as a potential trade. This probably won't pan out suddenly. I mean, I'm probably waiting until Monday to actually be trading this, but we're looking at a consolidation rate in here, and what we're looking at is this daily time frame, this channel that was formed. Let's just tighten that up. And this is what traders call a bear flag. You get your first impulse down or up. You get your first impulse to get you where you are in the market. Then you get this consolidation in the opposite direction. This is where banks, institutions will start accumulating orders. They'll fake traders out to thinking that, oh, hey, this downtrend is done, we can start buying. And look at the buy volume in this. This right here is just the banks and institutions faking traders out. And what I'm really looking at long term is for this to break and continue downwards. I mean, really, it will take 2 weeks to pan out fully for you to know, but hey, we got 4 weeks of training, so I'll keep you guys updated on this trade and how it's been going. 2 potential outcomes right now for this is we have a bounce off this trend line like we were talking about to this upper portion, or we break this channel like how I want it to and have the nice push down. And either way, we'll be able to make money because we'll be ready. That was 100. And we're looking at total maybe 200 on the breakout. I'm looking at it to mirror this structure that got us in. Maybe put that there. And then we can really be looking at 200-300 pips from our entry. So very good trade. Very high probability either one's going to pan out. But really, that's how we're looking at the market. We're going to these high time frames and just breaking it down chart by chart. And you want to align candlesticks with this, your candlestick analysis. So like your dojis, like I showed you on the other chart, I can show you here. So right here, I want to see the next 2 hours pan out bullish. So this candle closes up here, preferably above this this body. So I want to see this candle come up and close up here, and that will really signal me to enter this trade. So I'm looking at it to be up here when it closes. And that's just another part of the training that you guys are going to be going through. I'll send some PDFs in the group chat. It goes over chart patterns, candlesticks, what they mean. Does anyone here not know what a candlestick is? I know we have some new people.
I'm not really sure what it is.
Okay, good thing I asked that. So what a candlestick is oh fuck, Rudy, you're the best hype man. What a candlestick is the data where price has been in the market at a certain time. So for this instance, we'll look at daily. And let me zoom out a little. So each one of these candlesticks you're seeing is 1 day, 24 hours of what price has done. So what you'll, what up? I think someone's at the door.
Sorry.
Thank you so much. Okay, guess my door's open. Okay, so what this is it's 1 day of price movement. You have the open, the close, and that's what we call the body. So this whole colored area is the body, and where the highs and the lows of the market are these wicks. So I'll bring up an example from Google. Yeah. So each one of these green candles is, what the hell is going on here? Oh, you guys in the chat are too much. Okay, what's happening here is you get the open, and that will be the body. So this whole area from this close to the open is what we call the body. So price will open here on the given time frame, and this is where price will close. Then the high and the low will be marked by what we call the wick or the shadow. And in a bearish candle or a downward candle, it's just reversed. Same thing, just reversed in different color. So what you see here is we had open, the candle opened, or let's drop down to 15 minutes. So right here is where's my paintbrush? This is where the candle has opened, this bottom, and this whole area is where price has moved. Now we've had it make a high just right up here, then come back down and close. You can see a little bit more wick action on this one. So up here for this is the open, and this is where it's closed. And this was the peak or the bottom of where price went to before it closed in that 15 minutes. So as you see here, we have 6 minutes left for this candle to close. The highest it's went to is right here, and this area right here is where it opened. I hope that makes sense. I mean, sometimes I kind of suck at explaining. But does that make sense to the people who don't know what candlesticks are?
By open, do you mean like time-wise? Like what time it opened or what exactly?
Yeah. So when I refer to open, that means, see this little timer?
Yeah.
We'll drop down to 5 minutes. So we have 34 seconds left on when this candle will close. So 5 minutes ago, it opened right here.
So is every candle 5 minutes or?
You can, so up here is all the time frames. I stick to these here, the 5, the 15, the 30, 1 hour, 4 hour daily. But
Yeah.
each one of these presents itself different opportunities.
Different candles.
And as you can see here, towards candle closing, it's going a little crazy. But you'll see this next candle open and how it kind of moves. So let me delete all this. So that candle that just closed, it opened up here and it closed down here. The high of the market or of that candle was right there, and the low that it's got to was right there. And this next candle will kind of give you a good example of how it's happening again. We can drop down to the minute for more examples, but you will see how each candle will open and how each candle will close. And this really gives us multiple analysis points, how the market and traders in the market are responding. So when you're in an area of support and resistance and you're seeing these big long wicks and rejection happening, and when I mean rejection, it just means that the market isn't wanting to go past that level or isn't wanting to break that level, that's when we call it rejection. And rejection will look like these wicks. Rejection will look like candle patterns. So a candle pattern is just multiple candles that make up a given pattern. Like I said, I'll be sending some PDFs in the group to give you guys some resources to look at. But candlesticks are very, very important to know. They're very important to know what each one of them means, especially at critical points in the market. And again, just reiterating the fact here, this candle has opened right here. Let me get my brush. So this candle's opened right here, and it's making high, and this is where it's closing. Does that kind of clear it up on what open, close, and highs and lows mean?
Yep.
This candle in the middle here, this opened and closed at the same point. So it opened at 6628 and it closed at 6628.
The price didn't really move.
Excuse me?
So that means the price didn't really move for that because you're at 1 minute. So for that 1 minute, the price didn't change at all, right?
Yeah, so for that one minute,
it changed, but
made
it just
high
ended up
and
in the
low.
same place. Yeah?
In that 1 minute, it made a high and a low, but
But it
it
just
closed at the same price.
Okay, yeah, that makes sense.
So on a higher time frame, like let me try and see if I can't find an example. On a higher time frame, right here, that just kind of means the market is undecided. So this is 4 hour candlesticks that we're looking at. So this candle is 4 hours, this candle is 4 hours. And each one of these, that just means that the market's undecided on what it wants to do. So price opened at one price, and for that 4 hours, it just kind of fluctuated a little, and then it closed at that same price. Then for another 4 hours, it did the exact same thing. That just kind of means price doesn't know what to do at that point. To give you a further breakdown, we do have a chart structure that kind of makes sense why it stalled out at that point. So this is what we call a head and shoulders. To the traders that are new, you're probably like, what the fuck are you looking at? What do you see? But you'll get to the point where you can just look at this like how I am and see this left shoulder, this right shoulder, and this head. I'll show you the example on Google. But, so yeah, this right here. How did this shit go? So you got the shoulder, the head, the shoulder, and the neckline. And that's kind of exactly what we've seen right here. So we have the left shoulder, the head, the right shoulder, and this right here would be the neckline. And that's why price was undecided on what to do right there. Because we already had the left shoulder, we had the head, and then it came to this point where the other shoulder was formed and price kind of stalled out. That means buyers and sellers were fighting each other. Then eventually the buyers won, got their price move that they were looking for, which was how many pips? They got a 20-point move in their favor, and then they continued with the sell-off. So head and shoulders will look something like this. In this case, we have the market come up, make a shoulder, it makes a head, and it makes the next shoulder. Along the shoulder will be the neckline, and that's where you'll be wanting to look. Majority, when you spot these head and shoulders, you will only be seeing from here to this head. So it's your judgment to figure out when that neckline is having the bounce. Like in this instance, when we get these two indecision candles, because really in practice, when you're trading live, you'll be seeing this. So you'll see this left shoulder come up, this head form with a double top, and then you're kind of looking at, okay, well, we have price here that seems to be irrelevant, actually. Okay. We have price right here, so we can mark this out to the right a bit and just make a straight line and see how the market acts when we get down to this level of 67. And fortunately for the people who are in this trade, they got the bounce from the neckline, got their move, and then the market continued down. And the same thing will happen for when you're trading it opposite. So when you're trading in inverse head and shoulders, it will come down, have your left shoulder, your head, and your right shoulder. So this is a reversal pattern. So right here, if I show you again, the market from here is trending upwards. From this point here, we've had a pretty good uptrend. You can mark it out with the trend line. You can watch it, then it breaks. Then what we're getting is the reversal, and this right shoulder is just the pullback to continue back down. So we have our first move up, our left shoulder happens. We have to come back down, then our head happens, and then it breaks and reverses, and it will come back down to this where the trend started. And it's almost already at where it was. So that's a chart pattern for you. That's what we call a head and shoulders.
Toast. But just turn the volume down so it doesn't get burnt. Whatever.
So yeah, I'll be getting a lot more into chart patterns and candlestick reading in the next sessions, especially our Tuesday sessions. I'll really get into, because you'll be seeing me trade live. I'll be trading 15 to 5 minutes, following some trades up that we took last week, etc. This will happen for 4 weeks. Finish in with a Tuesday session where we trade live together. But really, this is the Forex market as a whole. We trade these currency pairs. They move day to day. There's different sessions in the day that you can kind of hop on and trade the volume. And really, that's how we do it. At first, I want you guys utilizing trend lines, support and resistance, that kind of stuff. But further down the road, you'll get into indicators, and indicators should only come after you know how to trade the market. Indicators can be very confusing, especially if you load up your screen with them, and especially if you don't fully know how the market works, how it moves, how that indicator works. I'll be showing you how to use the MACD because I feel like that's the best indicator that you can really use. One, as a beginner. Two, as consistent. It's really uncanny when you use the system that I'm about to give you in the next coming sessions. It just works time and time again. And you could have caught this move down very, very easily. Let me actually see. Yeah, you would have been able to catch this move very easily and make a good amount of money or good amount of points, pips, however you're counting your gains. Other things that we'll be getting into in the next coming sessions will be Fibonacci. This is just a retracement tool, something that you can put in practice when you're using other things like support and resistance, MACD, stuff like that. That's really it for this session. I wanted to make sure you guys really understood what Forex was, what each one of these mean, like the Euro USD. You really need to know what each one of these mean when we're talking in terms of this. And really it can be very, very confusing when you start. You're looking at a bunch of small little numbers fluctuating. You just see all these candlesticks. You don't really know what's going on till about week 2, week 3, when you're really doing it and really seeing how each trade that I'm going to be showing you pans out. For those of you that don't know what I'm on right now, go to tradingview.com. Tradingview.com. This will be everything trading for you. Make a free account and just go to charts, and you'll probably come up with some stock or some stupid shit like that. But what you want to do is you want to start to add, let's say, US CAD, stuff like that. What I really want you guys to do, if you're on the computer or you can, get NZD USD, because this is something that I'm going to be following up on, because that's kind of what I've talked mostly about today. That's the chart I'm looking at right now. If you guys, I know that we have the Facebook group, but we do have a Discord full of amazing people. Shout out to the Discord family that's in here. But yeah, we have everything trading related that you need to know. We've made, I mean, it's still a little messy. I'm working on that. I'm a one-man team right now. But we have an education section. You can talk to people, ask questions. I'll get you the link. But yeah, if you need help, if you don't know where to start in the Discord, go to education, questions, or even go to general and ask a question. Yeah, I'll get you the Discord link now. I'll post that in the Facebook group. Like I said, everything that you might need coming forward, especially if I'm not available, I'm a very busy guy. You can definitely get your answers from here. How do I do this again? Fuck, you ban someone? Okay. How do I get this link? Okay. God damn it, how do I get this? Okay, I think I have it in my phone. But yeah, so if you guys need anything trading related, pop in the Discord, ask questions. everyone's willing to help. Like I said, we have everything that you might need to know. Candlesticks, we have a full-on book about candlesticks. We have just tons and tons of resources at your fingertips, and tons of well-educated people, a collection of videos, just everything that you might need to know, a starting guide. I mean, it really is daunting to get into because it's a lot of categories. We have 300 plus people. Chats can move fast sometimes, but generally speaking, this is where you want to be. And like I said, I'll be posting stuff in the Facebook group for you guys. I'll be posting this trade, NZD USD, so you guys can kind of see this. So yeah, I'll be posting both of these, and I'll be giving you guys a link. If you got any questions to end this off with, do you have anything you're confused with, or